Okay, so thank you for joining me. Appreciate that. We hope to cover two parts. One would be application of technical analysis to instruments that are very volatile, like Bitcoin, and then also the psychology part of trade management. So let me first of all start with technical analysis. So this is the current chart that you have seen, a variation of this, which I have posted in the trading view in the published chart. So if you consider that the technical analysis, whether it works or it doesn't work, so what I will do first of all is I'll come back to that in a moment. Let me just do a new chart. Okay, so this is the row chart, and technical analysis is vast topic, and there have so many different features. So you may find that people have different approaches and they prefer certain elements and don't like other elements depending on their dispositions and their ability to grasp and their personal makeup. Many people, for example, will use the element of the price action in terms of looking at individual candles and looking at the volume and trying to read from that. So that is one part of one type of approach to technical analysis. They may, for example, look at this particular section here and say it is trending down because you got lower lows and lower highs, and that series continue, and then suddenly you reach an area, and in general that would be an area which either has some levels which are similar or in proximity to where the previous highs and lows or significant highs and lows are made. So in this particular case, you can see that when you're looking at this high low rather here, we approached very close to that, almost made a perfect double bottom. And then the people who look at the price action with the volume, they will be saying, for example, that during this decline we had the volume rising generally from a very low volume here, generally volume rising with a very massive volume bar on this 4-hour chart. And then, for example, instead of that, sometimes you might think that because of its high volume selling bar, you would expect the trend to continue. However, on this particular occasion, because this now happened in proximity to significant low that we had previously, what happened was at the end of the closing of the bar, you've got a very high volume and the bar closed well off the low. That means that whilst this market was collapsing, there were some individuals who expected the bottom to form in this area and are able to hold even if it should go a little bit lower, because they do expect that area to hold, and so they would have been buying, whereas a lot of other people would have been selling. So most of the sellers disappeared by the time we formed a low, and then the sellers became in the minority and the buyers then overwhelmed, so the price closed within like a third of the overall range of the bar. So potentially, not conclusively, but potentially at the close of the bar, that would suggest that there is a lot of smart money actually buying into this drop, because price closed off the low, not toward the bottom of the low. And then the next bar adds a confirmation. So in the next bar, you've got a bullish bar which opened at the low, went up, and the volume was low. Now that doesn't mean that we haven't got a new trend. Now what that means is basically the selling pressure has now eased off, and now potentially the new bullish move could take place. So if that's what you were looking at, and I'm not saying that this is 100%, because as you know, there are so many different approaches and disciplines in technical analysis, and none of them really work 100% of the time. So you have to have few different things to help you have a a high probability of a trade actually placed. So I'm not looking for these minor movements, and many individuals will try and trade these swings, and I'm not saying they're not tradable. Personally, I do not, so I'm not approaching technical analysis from that point. I will look at that in context of my overall analysis to see whether it is confirming what I'm analyzing or whether it is giving me possibly alternative view. So for the time being, you could have done that. You could have identified this as a selling pressure, easing off, and now the blue bar or the green bar suggests possibly a buying pressure now re-exerting itself. So then we have a kind of a bar with a top tail, which is potentially a bearish bar, but it did not have a follow through, and that happened even on a lower volume. So when for example, after this topping bar, which normally would be a bearish bar, we had a bearish red bar to follow, but it didn't have a follow through, and so the volume was moderate, very very low in comparison to, for example, what was happening here, and even in comparison to this bar, it was low volume. So what they would say is that after the selling pressure climax, we tried to go up and we had a test. This is a retest to see if there are any more sellers left. On a very low volume, we didn't have a follow through, so that cleared the way to go up. So in general term, and I'll come back to that a little bit later, but in general term, if you were looking at all of this, then potentially you could have planned a trade somewhere in this locality. On this is the 4-hour chart, so each bar is a 4-hour. Somewhere in this locality, you could have planned the trade. You could then maybe drop down to smaller time frame like 1 hour or 15 minutes and see if it is creating higher high, higher low. But in essence, if you're trading bigger time frame, then potentially what you could do here is you allow the trade to take out the high of this topping tail. Allow to take out the high. That means we've now got a high, we got a low, higher low, and we are now trying to produce higher high. So based on that concept, you could enter a trade on this chart, for example, at like 642 or maybe 645 as a kind of a round number, and you put a low as your stop loss. Because what you're not expecting now is for the stop loss to be triggered, because that would then confirm that the upside hasn't actually got much strength, but rather it is simply just a pause and it's coming back down. So this would be like an aggressive stop, or lower down here would be more conservative stop. But if you're looking for low risk entry, then this would be the low risk entry, confirmed by low happening at a place where you expect a low possibly to form. That's factor number one. Second factor is that we had a strong downtrend, and within that strong downtrend we had a last bar here which actually produced a high volume bar, but the price closed above the low, almost like third of the way back up of the range of that bar. And then the next bar was a bullish bar, and then we didn't really follow up, but we tried to retest to see if there is any more selling pressure. So based on that concept, you could safely plan a trade. So you could have entered a long entry anywhere here, right? And you could have gone down to smaller time frame to maybe fine tune the entry, to even reduce risk even more, or to fine tune the entry that you enter at a more optimum level. So based on that concept, you could have entered long and you would have had a stop here or further down. And as it creates a new high and does a retracement and then continues higher and take out that high, then possibly you could bring the stop to that low. And then effectively, you know what I mean, is each time it creates a high and does a retracement, takes out the high, then it's confirming the uptrend. So then you bring your stop to the last reasonable retracement. So in this case, that would have been a reasonable retracement here. Then this is just a minor retracement, but a significant retracement at this level. So you could have then brought your stop to there, and it continues to ride higher. But when you begin to get a parabolic rise like this, it depends on your perspective and overall method of trading. You could, for example, put a few other things on there. So you could, for example, put a trend line. So whilst the price remain above the trend line, you are bullish, and that your trade continues in the direction that you are currently trading. Okay, So this is very simple, and many people use that. But the only thing with this is that when it gets too far away from the price, from the line, there is potential for it to come all the way back. Now that may appear unacceptable unless your trading was like big swings. So in other words, you are really looking for not just $100-$200, but you are looking for a swing that have significant high. So in this particular section, the way I would have approached this, right, and I will understand that we've got this area which has actually produced a possible low, and there may be an expectation for this price to continue higher. But you could use different means. You could, for example, do few things which I often would do, and then try to form a picture in a composite manner. Okay, so you could easily put a Fibonacci retracement, right? Now here we didn't quite get to 50%. Here we shot over it. But if I just put one more level, you will probably see that we produce a significant level at 78% retracement. See, almost dead on, except that we just have a slight poke up higher, and then we close below. So something like that, you could be saying to yourself that I'll do two things. If it remains above this pink line, I would remain to the upside. Okay, I'm bullish, and your stop would be here. Then as the price begin to get more or less like more vertical, there is more chances of a price retracing. That's also the thing. So you could now, for example, on this chart, you could do a parallel, because up to here you got this low, this one, and this one. So you're able to put this trend line up and assume that you don't have any of the other prices. You could quite easily go and put a high, which you've seen me put on my chart. Okay, so this is not something new now that I'm trying to do this with a hindsight, but you've seen on my chart that I posted, right? So I've put it on this high, and I've also put it on this high, because sometimes it might just overshoot, in which case it will go for this one. So here you had a price running away from 68% retracement, so the next target is 78% in broad terms. Okay, and also you're expecting the price to go and approach or maybe just overtake that upper parallel of this now short term or intermediate term trend channel. So in that particular case, you could, as the price gets here, because you never know exactly where the final top is going to be, but if you entered somewhere over here, then over here you could be saying, okay, what I'm going to do is, because he's approaching 78% retracement and he's also producing possible test of this upper trend line, you might want to either scale out, reduce your position with a view that if it retraces in an identifiable manner, then you might want to then add back your position you took off. So you might still let one part of the position running. So you can split this trade in maybe 2 or 3 different parts. If it's just 2 parts, then you take one part off, or take everything off, take one part off and add it back when it reapproaches this baseline, or simply start taking off. So by the time it's gone up there, you've taken most of it off. Now this is just a normal fib retracement. Okay, there's nothing magic about that. Normal fib retracement. Also, you will note that you can do measured move. So these are all different types of technical analysis. That's what I'm trying to illustrate. So this is the measured move. Okay, so if, for example, in fact, up to here 50% is near enough more closer to the measured move, but this is the measured move. So if you were, for example, to plot this one on top of here, you see where you were expecting a possible top, and that was at 61.8% retracement, where we just paused a little bit. We didn't quite sort of had a reversal. So in this area, you could also put a minor trend line, right? So as far as you're above that, you're happy to stick around with it. So this measured move actually gave you a possible pause. Secondly, if you were to put this one here, and I will make that one thicker line and make it a green to help you stand out, so you can see it on the chart. Okay, now what I will do is I will clone that chart, and I will put it on the low here, right? Because I measured this move, it retraced back to here, and you can see one-to-one measurement came into proximity where we expected a possible topping out. So that now gives you 3 different reasons why you should be looking to get out here. Because one, it went above the trend channel, because it very rarely possible for this to just continue higher. So that's number one. Second thing is that you retraced 78% retracement. You also had one-to-one measurement. So all these things were giving you possible reasons for maybe scaling out or exiting. Okay, and then not shorting unless you have a facility to short and you are capable of shorting. But otherwise you allow, because it's still in an uptrend, so you allow for this one to drop back to rising trend channel. We had a minor breaches here. So when you have a minor breaches here, what I do is this, just like I did this at the top, what I do is I will put another parallel line just there, right? So the idea is that because we had minor breaches, so next time if you have a price breach within that, it means that it's not actually breaking the uptrend, because sometimes price does this, and as a result of that it sometimes travels sideways. So even though it doesn't show weakness, it doesn't actually reverse to the downside just simply by traveling sideways and breaching the trend line. So this is what I would do. So for the time being, we'd continue higher. So this particular element has nothing to do with Elliott wave. Okay, so I'm just using one particular approach whereby you do not have Elliott wave application to this technical analysis. This is simply just using straightforward Fibonacci's, straightforward concept of measured move and trend channels. And if you add a simple indicator, I have a favorite indicator which is RSI, or you could go and add a MACD. I wouldn't put RSI and stochastic both together, because whilst it may still help, I think they are both formula of derivative of this is very, very similar. And just before I go over further on to these particular indicators, I'm just going to make one comment and then I'm going to take the volumes off. Okay, so over here now you see, for example, we had this low. So in that low we had a flush out low with a high volume bar, then we tried to rally, and then we came back and dropped on this bar, and you'll see the volume is far lower than the one on a previous. So maybe again you could have said, because you put a Fibonacci on this one, this here I think would have been 78% retracement. Secondly, you see divergence in the volume. So if somebody just want to use the volume and price action with no indicators, then you keep all the indicators off, and you are potentially looking for this now. So you had a high volume bar, which was this red bar here. Okay, I'll put a vertical line on that one, and I forgot to actually cover the little earlier on, but I'm going to finish this now so I can take the volumes off. So here now we had a high volume bar with a high selling bar. We had a little pause, and then we had another drop, and in that another drop the volume was lower. That means that even though this is just as frightening for most people to look at it, there isn't really that much volume compared with the previous selling bar. That means the selling pressure is easing off. So if the selling pressure eases off, then the logic says that maybe it will just have a relief rally, if nothing else. Okay, so as it relief rally up there, you had volume dropping. You see that? Volume dropping. So what that is saying is two things. Even before you got up to here, it is saying two things. One is that this selling pressure seemed to have eased off, but because the volume is dropping off, that means the new uptrend might not be intact. So you would be only expecting a retracement. That's a picture you make up whilst you're still in this zone here, because until you take out this spike high, you don't know if this is a new trend or not a new trend, right? So for the time being, you would have had, people would be saying, for example, that this is now a trend has finished, this downtrend has finished when we broke below this trend line. Now that's possible. We did actually complete that down leg. That's acceptable. But is it a new trend or not? Well, here you see, for example, that the volume has dropped down quite low, and then as you look at it, we begin to see divergence in volume to the other side. See this green bar correspond with this bullish bar here. Then you look at the next big bullish bar, and the volume is lower. So actually now you've got a minor divergence in the volume. So you got volume doing this and the price action doing this, right? So that is suggesting that maybe this is now about to run out. So when you were looking at this dropping volume, price rallying, that means it is only having a relief rally and is likely to re-exert the downtrend. okay, because all that has happened is the selling pressure has eased off, and this is just a relief rally. And then when we got closer, you see a very clear indication where we had higher volume bar here, we had a price high but a lower volume. That's now signifying that we are potentially looking for turning back. And if at the same time you put the Fibonacci on, so just combining those few things, you would have been able to trade this one to the downside if you were looking to short, or if you were looking to go long, right? If you were looking to go long, you would have considered possibly exiting around here. You would have in that case, you would have had a mini trend channel like that. Okay, so nothing really clever about this is that you simply put a trend channel up, and here we had divergence in the price high and the volume. So certainly here you had a few candles which suggested that this pressure, if you had such a big bullish bar, and if this is going to be a new uptrend, why suddenly you get this? Well, there's only one reason why you would get that, is possible pause, okay? And that means the price has done this, it's going to pause and take off again. But when you had this red bar coming down, that was the signal that this uptrend could well be over now. We could well be over because we only retraced 61.8%. We never reached the 78%. So that, and then the price did this. That means now we are going to be breaking to the downside. So anybody who were long should have exited. So on this particular trend channel, I often do this. You see, when the price get too far away, I would then make a copy of that and I would place it just below this here, just so that it gives me an early warning. So I've got an early warning now from two perspectives. One is that I've got divergence in the higher high and the lower volume, right? So divergence there. I've got a breach of this minor trend line, and I also had a price action here suggesting that after such a big bullish bar, it just died out. So maybe this was just a trap. So if I was long, I would have exited below this spinning top here, right? Which is exactly, in fact, that one. I can't quite read the price of that, but vertically you are looking at it is about 980 on this 4-hour bar, 980. So any price below that, I would have exited. So even here, if I was long, I would have put my stop here, for example. I would have walked the stop up to here if need be, but now I would not wait for my stop to be taken out. If based on this, I see, I'd be willing to exit. And if I was looking to short, I would have then shorted it just below as the price breaks below the low of that spinning bar, and I put stop just above. And the concept would be then is a retest of this low. That would be the minimum expectation, retest of that low, right? And then some indication that we've now formed a low. And the low here, for example, formed in the same manner. You see, as the price started dropping here, is the volume start picking up. That means the downtrend is still in process, right? Just over here, where we had, higher volume as the price dropped. Here we had lower volume as the price rallied. So the low downtrend has re-exerted by saying that as the price is dropping, the volume is rising. Except when we get to a level where we previously identified a possible support. So here we had a possible support, and the price then suggested is diverging. Now on this time frame, it has given you a divergence in the price. It has given you a divergence in the price because you got lower low on the price, but the volume is less on this sellout compared with the previous sellout. So you could be looking for potential reversal, right? Potential reversal. Reversal would mean that you could have, for example, a downtrend line here, and the breach of that downtrend line would be your a possible clue that we are now breaking to the upside. So over here, if you were doing nothing at all, it came down from the higher low, then you'll be looking to say, take that one out and I'll be long. Or on this downtrend bar, if it takes that downtrend bar out, I will be long, maybe over here or over here. So anywhere somewhere about 730, 750 area somewhere, you could have probably attempted to long it with a stop just below, or at least below this swing here on a 4-hour chart. So that's the way I would plan the trade, and I'm hoping that you have learned or have confirmed and come to the conclusion that the technical analysis do work, and I've only sort of taken just one part of technical analysis. Okay, so if I'm going to take the volume off, because that will unclutter my chart a little bit, and I'm going to now, in addition to the volume and price, I'm now going to show you how I use the RSI or similar indicators. RSI, for example, you can put a price trend line on the RSI. Let me just focus on that. So just like the trend line we placed on the price, sometimes putting a trend line on the RSI is even more accurate. Not all the time, but sometimes. Okay. And the other thing I do, which I can't do on a trading view, so I'm going to put horizontal line on the in the RSI, and there's nothing really magic about that, but simply to suggest that it's like a center of this is a 50, reading 50. Okay, so as I look at the RSI, and there are many ways of reading the RSI, this is just one approach. So because I'm looking for bigger swings, I am not looking at extreme sells, okay, and divergence, but there could be something that you can bring into picture. So over here we had a minor divergence on the RSI as the price made new low, and the volume divergence also. So you got few things going for you to say, suggesting maybe we should be looking for possible signal to tell us that we are now going long, okay, or the trend has now exhausted. So if I put a trend line on my RSI, see the RSI breached the trend line over here, but it hadn't quite breached this downtrend line on the price. So it's given me an early signal or early indication that maybe now that we had a divergence on RSI, we had divergence on the price low and the volume, maybe there's a good reason to expect that this trend is now reversing. So now it's a question of entering the long trade, and entering the long trade in the way that the risk could be manageable and it could be safe for us. Okay, so using that concept, this breach of the RSI has given you early warning signal, but your trend line, because the price is the king, indicators are only indicators, and many people say indicators are lagging, and I do agree indicators are lagging, but in this particular case, right, and the way that I'm using, it doesn't always work 100%, but the way I'm using, I already had an inkling that this area was a potential change of trend. Okay, now on the price, you see that was only at this region here, so price then came down to retrace. So RSI, as you can see, came and just tried to breach above the 50, retrace, but on this occasion the low on the RSI is 40 plus. So if the RSI didn't go much beyond the 40, then I think now we are potentially in a new uptrend, because before we made a low, RSI dropped to 35, we made a low here and RSI dropped to 20, here we made a low and RSI made a higher high at about 22. So RSI is already signaling to me that we could be exhausting the trend, and here is confirming to me that potential trend reversal is in place. Okay, so RSI, even though it may be lagging, is actually giving me an insight into what's coming ahead. No guarantee, but at least looking out for something, so that when the price confirms in this area by making a higher low, I have a reason to expect that maybe I should be now looking for a long trade. Okay, and if I was short and I haven't exited already, I should now expect that maybe my short should be taken out. It should not be allowed to continue, because I could retrace that much deeper. So that's the way the technical analysis works. So that's one approach, and similarly you'll see on the MACD is that we've also had quite a significant noticeable standard setting, noticeable higher low rather on the MACD, and the price had a lower low. So again confirming that it's a divergence. Okay, and then here you see, for example, where the RSI was signaling earlier that by bumping onto 50 area, came down, and then it started hovering around 50 with a view that potentially it could break above. And we had here, it took over the falling trend line of the RSI and it came down as support. You see, so then the price came down and supported, and what we had is a hookup on the MACD, but the MACD then continued higher. So both of them are confirming MACD have no limit to the up and down side. So from that perspective, MACD is good for really big swings like this one here. big swing because it can oscillate whenever. There's no limit to the downside, no limit to the upside. So when you have a very dynamic and big move, MACD is very good for that. Whereas RSI is limited to low being the 100 and the high being the 100 and the low being the 0. So from that perspective, RSI is good for a shorter term, more quicker confirmation. MACD is possible good for really big swings. And even on the MACD, you could have put this trend line on there like that. So I wouldn't just look for crossovers, for example, like some people look for crossovers. I wouldn't just look for crossovers. But you see here, we came up, bumped into here, we made a higher low. Now the MACD has breached above that. So everything is confirming the possible trend is finished. So you see what I mean? I have no idea at all, and I'm genuinely telling you this. I am novice to Bitcoin. In fact, I am novice to a lot of the trading instruments. I keep tabs on some major events like Fed announcements and ECB or Bank of England announcement of rate, major data being released, that sort of thing. I do keep an eye on that, but sometimes I think they are either a potential catalyst or sometimes they influence the price. So let me just explain that in some way if I'm confusing you. I have no idea, for example, what caused this drop. In fact, when that happened a few weeks back when we were forming this top, I had no idea that there was a problem with the China, for example. I think that maybe people give China too much credit for what China is really doing, or the people who trade in China, what influence they have on the actual price. I think they give too much credence. It's easy, it's become almost fashionable to simply say, oh, China is doing all of this. Just as much as, in fact, if any of you know, back in 1988, 1989, we had a situation where in UK, many of the major conglomerates and companies, they were saying, wow, look at Japan. Japan was bombed out, came out of ashes, and has become number one market, right? And it was, in fact, at that time. The US was second, I think. So Japan is number one market. So everybody thought Japan is a success to everything. So let's go to Japan and learn about their secret. So they started sending their chief executives, marketing managers, personnel managers, all of them to Japan so that they can learn firsthand what is their secret. So in that they came back and they said, they look after their employees, and every morning they go up there, they do as a group workforce, as a whole department, they go through exercises, and they so they're all at one, and etc. And so the people are happy and they produce more. So that was their kind of, in a brief summary, that was their impression. So Japan was everything. But then what happened in 89 and 1990, Tokyo market topped. And then ever since, Japanese still have the same work practice. They still have the same management process and methods of managing their personnel. So what's happened now? Why do nobody talk about Japan anymore? So I think in that particular concept, you will see that sometimes we give too much to something. It becomes almost like a cliche. And I think that everybody in the trading chart who are simply saying, oh, this is China doing this, China doing, I think they give too much to China. China is not necessarily, it's a very large, and I agree that they do have a very big population, and maybe certain community in Chinese regions maybe addicted to gambling, and this trading in some way is associated with the gambling, so maybe it's their ultimate game. So I accept all of that, I don't dismiss it, but I think really speaking, there is much more that is happening in the price than just China. Okay, that's all I would say. But I'm not going to argue with anybody who wants to make a case, because I accept that a large number of traders, naturally they could possibly cause some real change in the market direction if it especially happens at certain news events. So that's as far as I would go. But I think really I would dismiss what Chinese are doing and what is happening in China. I would take not knowing what Bitcoin is, because I'm still learning the whole concept of these cryptocurrencies. I'm approaching them purely from chart perspective. This, as far as I'm concerned, could be oil, it could be gold, it could be platinum, it could be anything, right? I don't care that it's actually called Bitcoin. So based on that, this is the way I suggest that you approach charting. You can select whichever method of charting actually helps you and gels with your disposition and your ability to comprehend. But here I haven't actually brought in any complex theory. I haven't, except I've looked at possible divergences. I've looked at simple price action. So if somebody says the indicators are lagging, I agree. But in a certain way, use of certain indicators is not lagging, is actually giving you an early warning. And then if you combine that, not on its own, but if you combine that with maybe the price analysis, which is combination of price bars, the way they close, maybe combining that with a volume or some trend line breaches, maybe even fib projections, then you've got something going. So let me now just go back and look at the fib projections. So we looked at the fib retracement here. Okay, so let me take this off here. So we've looked at the fib retracement, but if you were looking at this here, then you could quite easily, and how you use your fibs, again, there are people have different methods of applying fibs. Some would simply put in, for example, like this here. Okay, so they would say this is one method. So if the price came down, went back up, and it comes back to this level here and breaches below, okay, they say that potentially it would go to the next level, and the next level they'll be looking at is this. So supposing you had no structure on this side here, and you're trying to find out what is a likely level here where we may expect some sort of a retracement. Why is my fib doing this? Style. Oh, okay. Okay, so in here, for example, if I did 1.272, which is the first zone, the second zone could be 138. Okay, or you can go to other fibs as well, but just put those on, and you will see that how it actually interacts. Okay, so on the downside, you can see it never got to this 127. Now, if that happened, the way I would read fibs is that if it never got there, and my everything else is telling me that potentially we could be trend changing, because RSI is telling me that, volume analysis is telling me that, then it should have got to the next level. But the fact that it didn't, that means there is a real strength in that bounce. That's how I would read it. Okay, but sometimes it will give you exact turns, and let me illustrate that what I mean. So take that off, and over here we were saying that potentially we were breaching this upper trend channel line, and if you were to apply fibs on this one, you will see how fibs will interact. So I will do exactly the same. Is I will apply the fib on this first upthrust here. Okay, take it back to the low. So this is the different way of applying of fibs. This is the process that the Elliott wave people apply, and the other one is simply people who want to trade Fibonacci's. Okay, right. Where have I gone? Let me just make sure I've got those ticked. 1.6 and 1.382. Okay, these are common fibs. Okay, so for example, I simply took this first upthrust, and if I was trying to identify where the likely turn is going to be, then remember on this retracement we said not that we said sorry, wrong area, looking for fibs in the wrong area. Okay, so here we were looking for retracement, right? So you can see now I've put in few different things together. I'm not looking at Elliott wave at all, so I'm not going to bore you with that. But we said, for example, 68 point retracement, and we also had 78%. Okay, so you can see that I've got 78% retracement of this entire decline, which comes into this area. I've also got the fib projection, which I projected from this leg and applied it from here. That means whatever the length of this is, projecting it forward, the first target is at least 1-to-1, which came here. Next target is 127 or 138%, but here I had 78% retracement and 138% retracement extension came in at a level where previously we also had a high. So now I think this is a significant area where either we will get a trend change or certainly noticeable retracement. If not a complete trend change, a noticeable retracement. So that's another reason now I would be saying to myself, okay, we're in an uptrend, we've started going parabolic, but it's approaching an area where previous high was formed, and it's a fib retracement of the entire decline and a fib projection. So now everything lining up, so chances are that there is a good reason why I would be expecting maybe this area to be 138 is 138. I was going to change the color to make it different, but never mind. So that's another reason why I should be looking for short. And in fact, when I was posting my chart previously, and I will cover that in a moment, but previously when I was putting this chart on, I also had my pitchfork. Okay, now I will cover the pitchfork in some other sessions, but I will simply just add this one so that you know why I felt there was a good reason. And that's all you can do. No guarantee about any of this analysis, but it's a good reason why you would expect certain things to happen. Okay, and if people were saying, well, if it goes to here, if you were saying that it's going to come down or reverse at 950, but it didn't, and it went to 970 or 980 or 990, then you're wrong. You see, these are different way of approaching, because those people who are commenting like that, maybe they're trading small swings. But if you're looking for big swings, then big swings take place at a certain places, not everywhere, right? So, and in that you have to allow on a very volatile instrument like this one, you have to allow $100 or $50 on either side without really blinking an eye, because there could be an overreaction. Okay, so here, for example, this particular pitchfork that I posted, and you'll see this is on my chart, and I had the upper parallel came in at the area, it went just above, and the price came back. So it went through. When it went through, I for a moment thought that maybe if it doesn't come back, this could go up to the next level. That's why I was suggesting that maybe we would expect a reversal at the top. But otherwise, originally I was expecting reversal in this area here, because I had a pitchfork coming down. I also had a fib coming together. That's even before most of this price was in. Okay, it was basically, I think when I was starting to discuss this, it was approximately in this area here. We were in that area somewhere when I was saying that there is a good reason why there we've got declining parallel. Minor breaches are acceptable, but declining parallel. Secondly, we have a fib confluence in that area, right? And then if you see a divergence on some RSI or something similar, then there is a further indication. And we saw, for example, on a volume, we had a reason also to expect a possible top. And that may not be, as I say, the significant top in a sense of a trend change, but at least expecting a retracement, right? So when that happened, for my Elliott wave analysis, I thought that was the top. I would be expecting now 5-wave decline. Now, so far, the 5-wave decline hasn't happened. So I have now looked at this, and the fact that I was expecting low to form, which it didn't, around about this time when the price started going up beyond the area where it should not, which was just about 960 area somewhere, 960, 964 area. That is where I then reviewed, and I am now of the opinion that it may well be, we have few things happening here. It may well be that we could go up and actually make a new high in this particular swing before coming down. Exactly where, I have no idea. But if I was also to put this on, just to show you on my, not on the pitchfork rather, this was supposed to be on the pitchfork. On the pitchfork, if I put in that level, right? So if this price makes it up, then in this area I've got potential 25% extension of this pitchfork coming in to play in that area. I've also got 161% extension of this first leg coming into that area. And then also on this decline, you can add one more fib, and you'll see the reason why I'm expecting something to happen in that region. Not that guaranteed, but something to happen. And if I'm expecting that, then I can be on the lookout. Okay, so in other words, I wouldn't be blinded. Right, see, so 88.6% retracement of this entire leg, which is nearly 90%. Okay, so 88% retracement of this entire leg decline comes into that area. 161% extension of that comes in exactly on top of each other. So if we make this price up, right, then potentially I could be looking for possible top in this section here, possible top in that section. So what will I be looking for now? So I will be saying to myself, okay, providing as long as this channel holds, we are still in an uptrend. I agree. So we should be looking to trade this to the upside. So if somebody wants to trade short-term swings, you could be looking for, if it comes. If it doesn't come, it doesn't come. But if it comes, I would only be looking to go long with a view that I'll be coming out, even though it might shoot straight through and go like a vertical rocket to the moon. I don't care. From everything else I'm saying, my expectation is not necessarily for this to breach here by significant amount. It might, like here, maybe we might get 1 or 2 bar up there, and we might even reach like 1250 or a little bit higher. But I don't expect a significant breach, meaning it is likely to turn back just like it did over here, right? So I'm expecting something to happen in this particular area. So if now we get a price drop back to this base rising trend channel, I'd be looking for a long in that area with a low here as my stop. And in fact, that stop, let me explain, is a catastrophic stop loss. That means if I don't get a chance to blink and somehow price just rockets, well, not rocket down, but what they call take a plunge and sink like a stone, then I'm not going to wait until this one takes me out at some much lower level. So this would be my protection as a catastrophic stop loss. So either this low here or just one lower low. So that means that if you read the price, approximately 850 would be my stop, with a view that I'm going to be considering long around 950, right? So $100. And what am I expecting? I'm expecting to reach this level here, which is about 11, if you make a round number, about 1150. So 1150, so going in about 950, going to 1150 is $200, and I've got about $100 risk. But that $100 risk is not by selection. It's a catastrophic stop loss. That means if my computer broke down, I couldn't attend to the chart, and the price just simply plummeted. If that happened, it would take me out over there. So then I've got nothing to worry. Okay. Otherwise, if price doesn't get there and it begins to now threaten, like over here, if it begins to threaten my rising uptrend channel line, then I don't care after that if it goes to the moon. I would be on my stop loss would be then brought up so close that I would only take a very small stop loss. Okay, so if I entered at 950, I would probably exit once this lower line that I put here begins to breach, or in terms of the actual level, if it breaches around about say 900, I would be seriously looking to get out. And especially if my other things confirm. So what will other things confirm? RSI, for example, will actually now begin to show weakness. I would also see weakness in this MACD. MACD would probably go up a little bit and then hook back down. So if it hooks back down, then what it is suggesting is a larger trend is still to the downside. So for example, over here, you can apply this trend line on the MACD over here like that. Okay. So if the MACD simply comes up to this trend line and gives up, then it is potentially still in a downtrend. Now I don't care at this moment, and please understand, I'm not making fun or suggesting anything. I'm simply saying I don't care what news might come out. I don't care what China will do. I don't care about big whales, what they might do. I don't care about some government action that might cause some a positive news to come out. If the positive news come out here and the price do not go up, my interpretation would be is that is now a catalyst for a trend reversal, right? So in other words, people in the know, they may be looking for the fact that anything positive, they'll be using that to drive this price to a level where they're happy to get out, and let somebody else hold the hot potato. That would be my interpretation. Even if the news is so bullish that US government has given Bitcoin a fantastic legal recognition or something like that, or that maybe some other important institution have adopted Bitcoin as a means of adopting regular transaction payments, I don't care what comes out here. If I do not see a confirmation of that news in two ways. One, because at the very time that on this 4 hour, if it was a 4 hour, at the very time I see like over here the price is going up like this, and then if I suddenly see a bar coming up right over here like that, big blue bar, okay, and I see massive volume in that bar, but then finally when the bar closes, it actually closes so that we have possibly something like this. So we have a big wick, and then the bar closes somewhere below. Bar closes like here, right? So that means bar went up on that big news, and it's actually closed, like a third or a halfway, right? Anything below a third, I would look at that as a potential sell-off. I don't have a guarantee about that, but potential sell-off, that means I will be now on the lookout for the next bar opening and the next bar closing. If the next bar opening and closing is confirmation of the fact that it's now red, I would be on a lookout for potential short entry if I was trading this to the short side. Why? Because it happened at an area where previously we had a top, or if it happens over here, right, just retesting this high, if it happened there, then it's almost like double top, and it's at a level where we had a Fibonacci confluence. If it happens at slightly higher level, then we are looking at this one here, 1150, again we have a Fib confluence. That's an area where real sell-off took place. So still I'm potentially on the lookout for a sell, right? If I'm wrong, then I would wait for the next bar to tell me whether I'm wrong or right. And potentially the next bar, if this is the bullish bar, the next bar will have a follow through to the upside, in which case you could get long on the high above that. But the risk has to be considered, because if the range is so wide that the risk is too big, then you have to wait until the noise dies down, it retraces a partial, gives you a small retracement, and then possibly you can enter. You can probably put a fib on that one. If it has a 50% retracement and it begins to start going up, then maybe now you can enter long, because then potentially you have a stop loss here which is manageable. But if it's over here, then the stop loss might be too big and it's not a safe entry, because it could be a trap, right? It could be a trap, and I think sometimes these things do happen. So for those reasons, I don't really give too much to China. That's one thing off. I think that's really a nonsense. Second thing off is that I don't dismiss the news. However, the news do have an impact on the price. Sometime they will be catalyst for the price to speed up the current trend, whether it's up or down. Okay, and at other times the news event might actually set the catalyst off, and therefore it will actually act like a trend change. And which way is the news going to impact? I have no idea. Sometimes you might find that on a bad news, the price actually rallies, right? And sometimes on a very good news, price collapses. So how do you interpret the news? At what stage do you know that the news is going to now affect the price, or the price is going to rocket to the moon, or the price is going to collapse and is going to come straight down? At what time, in which particular stage of the cycle do you look at that? And I think that's rather difficult to consider. So I would be based on that, I would not necessarily give too much credence to the news or expected news. But if the expected news is coming at an area where I'm expecting something to happen, like a potential price reversal, I would definitely keep it in mind, because I would then see what happens immediately after the news. It could be that the news could be a catalyst for me to actually expect the trend reversal that I'm expecting in that area anyway. And if the news is going to be a catalyst for the trend resumption, and that trend would simply accelerate, in that particular case, I would enter after the news has accelerated, expect a retracement, then I would enter. That would be my way of entering after the news event, or on the lookout for the news event as I approach a certain price zone, right? But anything other than that, I think news is completely waste of time. Completely waste of time. Longer term, I agree. Longer term fundamental do have an influence, because if the fundamental is really good, then long term it will have a translation into price. But in the shorter term, it is difficult to actually expect news event to define your trading strategy. I mean, some people do trade news, but it's for a very short term. News event do not help you to identify where you should enter the trade and where you should exit the trade. But combining that with technical analysis, it does. And the other thing is that how do you know that news is current? It might be already half an hour long or old, maybe 15 minutes old, and in which case all the people who's got hot button and they get a news instantly, maybe they're already ahead of the game and you are last one to follow. So that's my approach to a news. But this is the way I apply my technical analysis. I'm not bringing into view the Elliott wave, but at other times we will deal with that. But here now, I have now at the moment given you a potential outlook as to why I'm expecting a possible high of this swing up coming into that area. And few things will help me combine that. One would be is to see, for example, on RSI, right? So this is nothing new now. This is something you already know, and many of you have probably already practiced. You see over here, we will see RSI come up. If it doesn't come up, right, because the RSI at the moment is saying that particular zone we've gone into, the price could go up higher. But if the RSI fail to take out this declining trend line, then potentially RSI is giving you reversal or divergence, right? RSI is giving you divergence. Now, divergences can happen all over the place. So again, divergence all over the place is not significant, but they are significant when it happens at the level that you're expecting. So that's how I am using these indicators, not necessarily as a lagging indicator, but highly leading indicator, because I have identified where I think it's going to happen. It's going to happen over here, right? If the price goes up and the RSI follow, but RSI fail to take out this high, and the price actually give me new high, then potentially I'm looking out for a reversal. And in the same way, if the MACD, for example, if you want to combine those two, if the MACD goes up and it begins to struggle to get up to that level, and it begins to start coming down, and on a histogram is already coiling down, then I am almost confirmed that we are likely to exhaust our trend to the upside. So then, if you wish to, and people say I read price action alone, nothing else. Well, in that case, I say bring your volume back on and look at the way this high was made. Look at the volume. So if I again bring that volume in, just to highlight that, and then the technical part is finished then, I think, and I will then briefly dwell on the psychology part. Where is the volume? Here. Okay, so what you'll be looking for now is over here now on this 4-hour chart is you have you can't raise the bars on there. Okay, so if for example on here you can put a horizontal line on where this volume is, okay, that's where the volume is. So if we find now that on the next one we can find two things, because the volume doesn't have to be just one way, it can happen in two ways. One would be is that we know the high of the volume here when the price was there, right? So subsequently we have come down and the volume is relatively low, so we expect two things from the volume. Is suddenly we'll expect, just like the big red bars, we expect big massive green bar, maybe corresponding with a big bullish bar. And if it happens at an area where we are expecting retracement or trend change, if that happens with price bar with the volume rocketing up above this trend line here, let me change the color of that one to this this line, make it thicker, so you see. Okay, so if the volume goes above that, then you will be saying to yourself, okay, so what could happen if it's a high volume but the price closes off the high? If it closes at the very top of the high, then it's likely a breakout. If it is not top of the high and it closes back below, anywhere around a third of the way down, then I would interpret as a potential trap for the long, and I want to see the evidence of that. I'll take no action, I will take evidence of that. So on a 4-hour bar, I'll see what the next 4-hour bar does, and it's possible that before the 4-hour bar closes, if it closes below this one, it's already confirmed that this is a trap, and if I want to enter short, I'll be looking to enter short below that. I will already have an order below that, because I'm saying I don't care what happened with the next volume bar or next price bar, but if it closes below this big bullish bar, which everybody think is a bullish bar, if it closes below that, then all of this was a trap for the long. Okay, so if it comes down, then really you should be going short, or if you're in the long already, you should then be getting out. And then you'll see a volume maybe indicating, and volume could indicate either an exhaustion volume to the upside, or it could indicate that the volume is very small in comparison to this last bar, where price made a significant high, but there was no real volume on that bar. So both ways, the volume can help you either to confirm that there is a divergence, or to confirm if there is a genuine breakout, and that breakout of the volume could significant if the price bar closed at the high range of the bar. If it doesn't close high range of the bar, then I would interpret that as a potential trap, and the confirmation would be on the next bar. Okay, so in those particular ways, you could be looking out for a possible top around 1150 or maybe even 1200. And because this is a volatile pair, you can't be absolutely exact. You have to allow some error of margin, but hopefully those are only a minor part of your bigger swing. So if you have an error of margin of $50, $100, and you're aiming for big swings, $500-$600, then I think that minor error is acceptable. If you're trading 5-minute and 10-minute chart, then you can't have an error of $100, because your overall move might only be $200-$300. So that's my way of trading. I'm not saying that's the right way of trading, but I've shown you here that technical analysis do work, completely oblivious of the news, completely, even if you have no access to the news at all. You might wonder suddenly something has happened. Yes, I agree, but it doesn't alter the overall analysis, because your analysis, you are looking for certain things in certain area. If it confirms, then your analysis is good. If it doesn't confirm, then your analysis needs to be re-examined, because it could be that we've got a new trend in motion and we will now take out significantly this high, maybe go to 14 or 1500. So either way, technical analysis do help. Now in terms of psychology, I will only briefly dwell on that one, because it is really a big subject and it's not necessarily speciality of mine. But in terms of psychology, at the moment, the way I am interpreting the traders of Bitcoin is that they think the Bitcoin is going to the moon come what may. And I think, okay, I agree with you, but it's not going to the moon with just one-way ticket. It's not going to the moon with no retracement, with no minor trend changes, intermediate trend changes. Just like over here, everybody here was saying exactly the same thing. Is going to the moon. Is never going to drop below 500. Is never going to drop below 600 or 700 or 800. Is never going to drop below 700. Many people said that, but look, we came to 450, right? So the idea that is never going to do this, I think, is very emotional. And the reason why it's emotional, because they've already wedded to a long position, and they could be very emotional because either they are taking significant pain, like they're being stabbed in the chest, literally, because the price is dropping. And so for them emotionally to cope with that, they will be saying, no, this price cannot go that far, right? If they don't have a stop, then they're severely bleeding, and they're hoping against hope that this price is going to rocket back up to a level where they can exit without too much pain. So psychology could be that denies all possibility of a price coming back down significant amount, meaning more than they're capable of accepting or thinking, estimating, more than their expectation. So in that particular manner, it is majority of the traders are extremely bullish. Now long term, I agree, but they have to allow intermediate term that there is going to be ebbs and flow, and in that concept you'll find prices significantly go up and make a retracement, and there is no way of knowing just exactly what the retracement is other than the common fib retracements, and then combining that with other technical analysis to help us fine tune likely lows and highs, Fibonacci's, along with trend lines, along with maybe some previous support resistance, a combination of some indicators and maybe volume analysis could help you identify and isolate major points. In between is very difficult, very difficult, other than the fact that you can trade trend and don't fight it. Okay, but once the trend changes, then if this trend change, then if it only came down minor and then started rallying, then that's telling you that that trend, what people were expecting a trend to continue down, had no downtrend to follow. There was no follow through, meaning that it's a false breach, and therefore it's a trap for the bears and is likely to continue. So then you would then consider safely entering the long with having some manageable stop loss. Okay, so that's one aspect of trading psychology. The other aspect is people get trapped at the wrong end, and majority of the people who get trapped either get trapped at the very high or at the very low of the swing. I don't mean exactly here and exactly there, but if you take any of this swing, some people said I exactly sold out here when this low was made, and in fact this one here they sold out. Somebody actually commented in the text earlier, they said they sold out at 850, right, and the price is now going up there. They were long, but they sold out at 850. They sold out too low and too cheaply, right? So why were they selling out? Because they were thinking that maybe this is going to continue down, and with this big red bar they thought that's it, it's now new trend is resuming to the downside. I was expecting this new trend to resume to the downside, but in essence it didn't really have a follow through, because even before you had this one, we had this bar come down, but it went back up above this rising trend line. Okay, if you had parallel line put in here below this bottom of this green bar, this price came poked and it never had a follow through. So the moment it never had a follow through, potentially there's a reason to expect that maybe this might not continue down, and we might at least have a bounce that could go to retest this high here, or maybe even go up and make a new high. Okay, for new high for this particular swing. So the psychology would be is people thinking that I better get out, fear, or they could be greedy in a sense that when this happened here, I mean, look, if you just go back, we were at a significant area, right? Significant area previous, and look at this green bar. It actually went, if you put a line up there, and I take everything off now, so I'm going to take everything off. So you just go back to the clean chart, remove all technical, okay, and I'm going to simply put, okay, there, right? So when you had this big bar, is acceptable that people were obviously bullish. Then another reason to be bullish. So then you had big one here, people were bullish. So the bullish continued. Then we had significant bullish bar, and then look at this one. This one almost it opened here, right? It opened just there, and it tried to go up. And as it tried to go up, what happened? Actually, my mistake. Here we had a price open here, and it came down, right? So that would have produced a potential red bar in this zone here. Okay, in this zone it was producing a red bar, and once that red bar disappeared and we became green again, what were people thinking? They were thinking, and all those people thinking this is going to go to the moon, they were thinking that now we are about to break to the upside, because look, this was a red bar and it turned back green and is likely to break out. So they don't want to lose the potential breakout, so they are greedy and they want to try and enter long. And many people, I believe me, did enter long, because everybody who saw this bar when this was big red and it went back up were of the opinion that this is going to rocket up. So they would have gone long, or those who were already long, they would have held on to it because they were expecting this is going to go to the moon, right? But what happened? Immediately when that one finished, we had this hesitating spinning bar. So that immediately, as far as I'm concerned, called into question a possible breakout, because you do not expect that at a significant level. Somewhere in between, I agree, because the price has been rising, comes to an area, pauses, and then continue. But immediately where this bar was looking to threaten to break up, and we had possible hesitating bar like a spinning bar, look at the bar, right? So the moment you had that to me would be a significant warning that this trend may not continue. So if I was in the trading instrument for this one, I would have immediately said, okay, if this is going to the moon, that's fine, I'm happy with that. But if it takes out the low here, right, this low here, I'm going long, I'm going short rather, right? Or once that bar closed, see where the price opened, it opened lower than the previous close. So immediately I would have raised the stop sell to below that particular bar, because if the price bar continue, or maybe few dollars below that price bar, if the price bar continue, then it is only going to trigger me short if the trend actually reverses. If it doesn't reverse and it goes up, I have nothing to lose, right? Because then I would wait for a price to break up and possibly make a small retracement, either to retest the previous resistance and continue higher, or to go up and retrace partially and then continue, then I would enter a long. But otherwise, this I would be entering short. And in fact, that wasn't the reason I suggested a short, but I was on the BB's Coin Chart Connect session live, and I was saying this one from my Elliott wave perspective was an ending diagonal. Because that was an ending diagonal, I was happy to say if somebody can short this one with $50 stop, then it's short right now. And the expectation was the retest of this low. That was my minimum expectation. I wasn't expecting this to drop as far as it did, but expectation was this was the low. So this is like, 850 area, for example. So 850 area, and the short would have been here around about 1180, 1185, in that kind of range. So that would be a good trade with $100 or $50 stop. So psychology is that at a major significant level, and that's the only area you consider psychology. In between, psychology has no play, because everybody is tossed about like waves in the sea. The waves in the sea have no real pattern. They're all random, up and down, up and down, up and down. That's why everybody says that the market is random, because generally that's what you see. This is just waves in the sea. Ripple, 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 ripple. Sometimes one ripple affect the other ripple, and it becomes a compounded ripple. And I don't know exactly what it would look like. So this is what people call noise. But when you clearly identify certain levels, right, there are some people just trade the levels. So they will, for example, go on the chart and they do nothing more than just produce levels. They'll just go and plot that. Okay, it's simple idea, but just what you know. Just put levels of what you know, and then you watch when the price gets there, and you then apply a few techniques. When the price gets there, you look at potential volume, and you see the closing of the bar, and you look at potential RSI, right? And combination of these, combination of that, and combination of some technical analysis of maybe trend lines, you see, or the channel, and combining those few things, you don't have to be geek at trading, right? Combining these few things, I mean, this particular trend line put on a high here, almost picked out this high. It happened at an area there, right? Not applying Fibonacci or anything. So if we now begin to struggle up here, then that's another reason for potentially exiting the long trade and coming down with a short trade, right? So that's my contribution to the topic of whether the Bitcoin gels or conforms to standard technical analysis or not. I think I have showed you how I approach this in my particular way. You will have different ways of doing this, and in whatever form you do this one, I think it is highly technical, and I also expect that as the price of Bitcoin grows and as more traders begin to get themselves involved in trading Bitcoin, then it will become more and more technical. It will conform to more technical analysis than it did in the earlier stage, where things were really, really wacky. It's still wacky, but it is more conforming to technical analysis, because at the end of the day, what does emotion actually do? Emotions in people, in very crude form, it does few things. One, causes them great fear of either losing the money they've already got, or fear that they're going to miss the move, so they want to be on the board. And some people will be very fearful, and some people will be fearful of missing the move. Some will be fearful of missing or losing the profit already they've got. And the greed would be is that they think this is never going to stop, right? I better climb on now, otherwise this is not going to come back again for me to climb on and buy this lower level. So they will be fearful of missing the move, so they'll be greedy. So those kind of things become particularly focused and more in sync at significant levels, like here, right? You will see, for example, if you even identify these ahead of time, do your analysis, produce trend lines, produce fib ratios, put on RSI, maybe minor trend line RSI, observe possible divergences, all this kind of thing. But also, if you observe the chat room and all the people, when we get to a significant level, you'll see a lot of people start putting their comments. They don't put too much comment in here because they are more casual. Sometimes they get frustrated, and what happens is they start attacking each other. They start attacking each other in saying that look at you, your technical analysis was wrong, right? You were wrong. I don't use those words in my vocabulary. I don't use those derogatory terms. I've never used it in my interaction with anybody on the chat, and I haven't used it in my presentations. It's really not in my nature, and it's almost against my principle. So I don't use those derogatory or degrading kind of terminologies. But what I'm trying to say is that people poke fun at each other. People call each other idiots. People call all sorts of names, everything, just because they happen to be on the right side. And they will start poking fun at other people and degrade them. But that happens here because they're frustrated and they're taking it out on each other. Nobody knows. So that's my understanding. When you see a lot of people attacking each other, I see often that's an area where we are not going to get a lot of follow through. But when people begin to suddenly start talking about, oh, what's happening? Oh, this is going to the moon. You'll start seeing comments like that, and the chat becomes so active that you won't be able to keep your eyes on the chat. It's sort of comment after comment after comment. And in that particular circumstance, if it happens at a significant level, I would say that this is going to be quite important for me to watch. Now, I'm not going to take cues about going long or short based on what they're doing, but nevertheless, if everything expected at a certain level and I begin to observe what they're doing, I'll be on a lookout to see if it now pans out based on what I was expecting, how it's going to turn out. And my trade would be planned ahead of time. That if it does this at this level, I will be looking for considering a long trade, or if it does this at that level, I'll be considering a short trade. And then I will observe what happened in the price, and I gauge the emotion. If you want to keep a note on the comments in the chat, both in terms of activity in the chat and the nature of comment in the chat, that would give you a clue into overall prevailing sentiment. That's the easiest and the most quickest way you can get to the sentiment. The other sentiment would be is keeping an eye on the price volume, because if the price volume, for example, when I see something like this, say price has been rising, and suddenly when you see this big green bar, right, that would be like massive breakup. But then if you look at it afterward, there wasn't really that much follow through. It's almost died out. So if that happened, then I'm looking at that. If that died out, is this going to go all the way? Because potentially we're going to go close to the resistance. And maybe many people are doing is trying to entice the new long, right? They've enticed the new long and then it dies out. So many people will say, okay, I've just entered the long, my stop is here, I'm going to be patient, I'm going to let this market work, right? And as price hovers here, many will be saying to themselves, well, maybe I should be looking to go long because this is now going to go and take out this high. They're looking at this high and they're saying they're going to miss out if they don't enter now. So many people will have entered during this pause. Then it's gone up, so they feel vindicated. Then immediately you see things turn back. So in technical analysis, based on what I have learned, is that you cannot be dogmatic, and that just because you happen to be on the right side for a 1 or 2 bar or a couple of days doesn't mean that you are right, because you will be proved wrong miserably. One individual, for example, earlier on has been putting chart out, and he's been sharing his sentiment with somebody. He's also calling somebody effectively meaning you're a dirt. And I think, no matter how good he is, he has no right or real reason to feel he should demean somebody like that, because his technology or his particular analysis is suggesting that this is, big bullish, and he's saying, big golden cross. And golden cross in technical analysis, you know what it means. It means 200 period moving average and 50 period moving average. If I was simply to go ahead and plot that and then conclude my comment, I'm simply saying this, that when people do this, they allow their sentiments and the emotions to be overwhelmed to the extent where they become so convinced that they will ignore everything else, and they won't always get caught out. Many times they think they are right and they will be sort of vindicated, but there will be time when they get caught out. They'll caught out in a very big way. So moving average here is moving average here. Okay, so that's one moving average, another moving average. Okay, so if one of them was 200 input, I'll make that 200, and I'll make that one okay, and the other one I will put it at 50. Style, I'm going to make that one red, and this one I'm going to put it, make it blue. And I think to illustrate what he was saying, I would probably have to drop down to a daily chart. Okay, not a daily chart. Then what chart was it? It was because that's too far. So let's go back onto the 4-hour. Okay, so I think what he was suggesting was possible this area here, which, it's not wrong to say that. Okay, it's not wrong to say that, but that's where he was suggesting. The red is a 50. Well, this is just to illustrate. I'm not saying exactly this is what he said, but it's simply to illustrate the concept of people getting too wedded to their technical analysis or viewpoint. So here we have rising 200 period moving average. Price went above it, so that's bullish by anybody's nature, right? And up to here, one can't say it was bullish because the 200 period moving average is actually slanting this way, right? So you can't say 200 period moving average is really bullish. And then the red was trying to go up here. So normally what you would expect is a red to go up there, maybe kiss the 200 and turn down, right? But instead it crossed up. So the fact that it's crossed up, he may be saying that this is the golden cross. And this golden cross is so magical that it works 100% of the time. Now, if it did work 100% of the time, then the reasonable logic dictates that everybody would use that, and therefore they will all travel to the moon together, right? But I would put in a counter argument, is what is to say is this price is really going to have a follow through, and we are not million miles away from where it took place, because if you look at it on the bottom side of this 200 period moving average, look, this here is of a greater magnitude than where the price is above the 200. So really he's not out of the wood. If he wants to stick to his gun and start poking fun at people by saying that just because he crossed here golden cross, it is magical and it's worked 100% of the time, then I would say that he has no real reason to suspect that, because this my technical analysis is telling me that unless the price take out this declining trend line, we have a potential problem to his view. Second thing is that below the 200 period moving average, we were so far, we dropped down here, right? Over here we didn't drop down that much, but over here we dropped down so much, and over here the price hasn't really gone that far up compared with this drop. Secondly is the moving average over here was very, very strong, right? So you would expect this one to have worked out, but over here the 200 period moving average is almost flattened out, and it's only just dipped, and it's look, this is not exactly, this 200 period moving average is not going like that yet, right? Like it did over here. So who is to say that at this particular point we might not get an action like this? You make up your own mind. So who is to say we might not get an action like that over here and then come down? And then what will this 200 period moving average do? 200 period moving average could possibly just go up a little bit like that, right? With the price somewhere in that area, for example, with the price, and then the red moving average could begin to flatten out. okay, and the price has gone up, and then it would drop down, because red, you can see, is already beginning to level off. It's not as steep as it was before. Its inclination is now reduced. So if the price spend a bit more time in this area, the red will begin to flatten out, might even flatten out, might even start pointing downward. But if not pointing downward, at least straighten out or lose the momentum. Then the 200 period moving average could go up there like that, okay, and then the price has gone up to this level or made a new high at about 1150, and then price drops, and the 200 and the 50 period moving average from here then begins to turn down also, and then you know what I mean. The 200 period moving average will flatten out, and then we'll actually get a golden cross back the other way. Now if that happened, then we had a golden cross, but there wasn't really a massive follow through or price action. So chances are this is going to fail miserably. So I would say that if this 200 period moving average is so clever and it didn't have a follow through, then I think it's going to have such a massive disappointment that we will probably take our 450. And at the moment, there are many people saying to me that, are you still talking about 450? Are you so still bearish? Well, I'm not, but that's my expectation at the moment until I get completely out of the wood. If we're not out of the wood, this is not going to have a follow through, then there is a chance that it will come back to retest that, just like when we had this rise up here and it came back to retest to see if there's a selling pressure. People don't know if there are major sellers still in until this is tested in some way, and it can't be tested over here. It has to be tested somewhere in the proximity of that. So this, I think, has a classic example of potential failure of this 200 period moving average, and we may actually cross back down and take out the 450, and that's not taking into account Elliott wave. We're simply saying what happened with the golden cross applied on, well, I'm applying it on a 4 hour. I don't know which particular time frame he applied, but he made me feel uncomfortable purely by his insistence in what he was saying and how he was posturing himself and poking fun at folks. But anyway, that's enough. So I think you gather how emotions get involved and what emotions should be at extreme levels, at a level where you expect certain things to happen, and that's the only time I would take emotions into account. At other times it matters not. At other times it also matters not if you get divergence on RSIs and whether there are top and tail bars. In between it doesn't matter, because that is all noise. But where it happens at a level that you're expecting, then it takes on a major significance. So thank you for your time. I will end the recording here, because I think it's going to get very long otherwise, and then I will gladly answer questions and entertain any other alternative